Hi guys, this is Dan from the Investment ABC, your guide to financial freedom. In this video, I want to discuss whether the stock market and particular EV stocks are in a massive bubble or not. For those investors who are new in the market, a bubble is when an asset, in our case EV stocks, rise sharply in price in a short period of time. The price is getting more and more detached from the fundamental intrinsic value of the underlying asset. Investors are just buying the assets so they can sell it at a higher price to someone else. At some point, the price is so high that the first, mostly smart investors start to sell, which leads more investors to sell to secure some profits. Many people just bought the asset because it increased in price without doing the proper due diligence. These investors typically sell in panic at any price to get out quickly, which ultimately leads to a massive crash and depressed prices until value investors come back in to buy. In the recent 2 months, many new investors entered the stock market for the first time and they bought some stocks and made really good money. And they might think it is really easy without understanding fully the risks. So I just wanted to make this video to make you aware of the reasons why in the end many of these new investors will most likely lose all their money, so you can avoid these mistakes. Now that you know what a bubble is, let us have a look at some bubble examples from the past to understand what was happening during that time. The most famous stock market bubble in recent history was the dot-com internet bubble, which started around 1995 and popped in the year 2000. It was widely expected at that time that the internet would revolutionize the way we live and boost our GDP significantly. So investors bought every company which had anything to do with the internet, disregarding any fundamental metrics like revenue, PE ratios, cash burn or balance sheet. Investors were thinking that these metrics don't matter anymore since these companies would make money at some point in the future and that the growth would be exceptionally high. So the media started to mock value investors like Warren Buffett and his investment style. The Nasdaq Composite rose 400% from 1995 to 2000 to above 5,000 points, only to crash 78% in 1.5 years to around 1,100 points, wiping out all gains of the past years and with it many tech companies. Whenever you see these kinds of parabolic rises, especially in the monthly time frame, you should be worried and think about taking some profits, in my opinion. Obviously, no one really knows how far a parabolic run can go, but in more than 90% of the times, they end in tears when the move comes to an end. I remember that time very well because I and my friends bought our first stocks exactly at the peak of the bubble. I had no idea about valuations, TA, or when to buy or sell since there was no YouTube or proper internet to learn all of these things quickly. You had to go and read countless books and learn from experience. I was extremely lucky that I just traded stocks in and out, unlike my friends who held and lost 100% of their capital after the bust. They haven't touched any stocks after that experience like many retail investors, so it took the Nasdaq exactly 15 years to surpass the bubble high. Many former high flyer companies vanished and only those companies with a solid business model like Amazon, eBay or Qualcomm survived after losing 80% during the crash. So it is extremely important to understand the business model of a company, its competitive advantage or moat, and its long-term prospects. Benjamin Graham, Warren Buffett's mentor, said once that in the short run, the market is like a voting machine, tallying up which firms are popular and unpopular. But in the long run, the market is like a weighing machine, assessing the substance of a company. This quote is so true. At some point, prices will meet the stock's intrinsic value. In the end, you are buying a company, and when the company is successful, price will follow. Just look at Amazon, for example. And on the other hand, when the company is not successful and doing poorly, it will just vanish together with your money. Another example of a bubble was the crypto bubble back in 2017. Man, I haven't seen a bigger bubble than this one. If we have a look at Bitcoin's parabolic rise and crash, we can see how a bursting bubble looks like. The end of a bull market is accompanied mostly with a bubble that was inflated due to high retail participation and greed. If you are new to investing and many of your friends and family members started also at the same time, and you guys love to talk about your latest picks and how well your portfolio is doing, well, it is time for you to get worried, in my opinion. Now, let's jump to today's market action and the EV companies and see if we can find parallels to the bubbles we have discussed already. What we can see in the chart of all of these companies is that in the last 2 months, prices increased significantly no matter what the company is doing. Tesla shot up from under $400 to more than $1,200 and is now the most expensive car manufacturer in the world, surpassing Toyota. This increase was accompanied by the highest retail participation since the dot-com bubble. In March, when stocks crashed significantly, investors like Warren Buffett and Charlie Munger sat on their hands and did not buy any stocks since they couldn't find any good deals in the market, despite having the largest cash position in their career. Note that they normally don't like cash since it doesn't produce any passive income. On the other hand, many beginners used the crash as the opportunity to enter the market. They were searching the internet on how to start investing in stocks. And as of now, these new investors did quite well in the market and beat Warren Buffett's performance by a long shot. And once again, articles are appearing how Warren Buffett lost his mojo. We will see about that in a couple of months and can decide for ourselves if it is the case or not. What typically happens when retail investors start to enter the market is that they suck in more and more other retail participants by telling them how much money they made and how easy it is. This is a dynamic which can push prices higher, especially penny stocks or stocks with a low float. Since the Fed created trillions out of thin air by expanding the balance sheet and the US government used this money for stimulus checks, and a lot of this money found its way into the stock market, stocks began to skyrocket, and we have reached a point now where fundamentals don't matter once again anymore. What matters to most of the people is that the Fed will do whatever it takes to drive the market higher. They're even buying corporate bonds so broke companies have enough cash reserves and can't go bust. On the other hand, millions lost their jobs, but hey, they're still making more money now than when they have worked, and a little bit of that extra cash is going back into the stock market, so what can go wrong? The Fed and the government basically bailed out the 1% of the people who own stocks with these actions, and on top of that, they have created this euphoric environment so the 1% can exit their stock positions quietly and distribute their shares to the retail investors. After they have sold, the markets will slowly begin its decline and the crash will most likely start. Here's one of the most important charts to understand any market, in my opinion. At the end of every bull market, euphoria is great and prices rise very sharply in a parabolic move, only to crash down massively. After the crash, there comes a little relief rally where investors think prices will get back up like always, only to see the real crash starting. Most of the time, new investors hold on to their stock which they bought at inflated prices because they just don't want to sell at a loss, or in the case of the crypto bulls, because they believe in the tech. In the beginning, they look every day at the portfolio only to see declining prices, and when prices are at rock bottom, either they panic sell or sell because they don't believe in the company or the tech anymore and move on. Most of the time, it takes a very long time for the market to crawl back up because at the bottom, most of the people hate the asset and only the picky value investors buy. Now, suddenly fundamentals matter again. They buy because of the dividends or other important metrics. After value investors have accumulated slowly, the hedge fund managers and other entities start buying and the cycle begins again. So what do you guys think? Where are we in the cycle currently? I just wanted to tell you quickly the most important things I have learned so far in the markets to be successful. Number one, you have to understand that psychology is driving the markets and that you have two great enemies to overcome. They're called greed and fear. If you can master your emotions and be worried when everyone is greedy, and on the flip side, be brave to buy when everyone else is fearful, that is when you make consistently money in every market. Number two, the price of a stock and the fundamental intrinsic value of a company is not the same. They can deviate as far as day and night, and your number one job as an investor should be to find out if the price is above or below the company's intrinsic value. At some point in time, price and intrinsic value will meet, but it can take a very long time, sometimes even years, for that to happen. Number three, don't buy at any price. Try to figure out how much the stock is really worth by thinking that you're buying the whole company. Would you spend 1 billion, for example, for Mr. Wong's restaurant next door, which generates only 200,000 per year in revenue? I don't think so. So do exactly the same with the stocks. Number four, understand the business model and the story behind the company and why you own your shares or want to buy them. Number five, understand that the real economy and the stock markets are often not going hand in hand in the same direction, similar to price and value. Currently, we have the worst possible economy, but a booming stock market. Number six, the number one driving factor of asset prices are interest rates and liquidity. Number seven, compare dividend yields of stocks with bond yields to understand where all the liquidity is going to. When bond yields are high, the stock market tends to go down because bonds are safe and attracting capital with the high yields. Currently, bond yields are almost zero, so the money is going into stocks. So there is always a competition between the stock market and the bigger bond market to attract the capital. Number eight, learn technical analysis. It helps a lot to determine when markets are overbought or oversold and to understand the overall health of the market. Number nine, and finally understand that the markets are used to transfer money from one group to another, mostly from the greedy people to the patient ones. If you understand and really internalize these rules, I'm sure you will make money in the stock market over the long run. Now, could the EV stocks go higher in the next few months? Yes, of course, especially in the end stages of a bull market. Stocks see incredible gains, many percent each day, and no one really knows how far the parabolic rise can go. You just have to know that at some point reality will hit the market, and similar to the crash of the dot-com bubble, only the best companies will survive and prosper. But prices will first come back to a reasonable level or even below it before they start to increase slowly again. A reasonable approach would be to sell a part of your shares to get back the initial money you have invested and leave the gains in the stocks. When the stock has a larger pullback or crash, you have enough cash to increase your position. This works well when you really believe in the company, but the stock price reaches boiling levels. I'm a long-term believer in NIO and also think Workhorse Group might have a chance to survive long-term if they get the USPS contract, and I'm applying this strategy to these two stocks. In my opinion, the price of the EV stocks just ran up too quickly and a bigger pullback is likely and also healthy. I think the driving factor if the run-up will continue or not is whether governments around the world keep supporting their citizens with free money or if they reduce the handouts. Trump will most likely support another round of stimulus payments because of the election, so we have to wait and see what happens. This is just my personal opinion and by no means financial advice. I just wanted to share the common mistakes new investors are making and why a lot of them are losing all of the money and pinpoint out that the EV market could be in the middle of a bubble. Finally, I would love to know how many of you guys entered the stock market recently in 2020 and if this video was helpful for you. If you enjoyed it and learned something from it, press the like button to support the channel and subscribe for future videos. Bye guys and see you in the next one.